Right now, in London, nearly 1 in 3 homes currently listed for sale was previously a rental property. That's not a seasonal blip. According to Savills data published in early May 2026, former rentals accounted for 30% of all new sales listings in London over the year to March 2026. Compare that to the rest of Britain, where that number sits at just 13%. London is at more than double the national rate. And at the same time, fewer than 1 in 10 of those sold homes is ever going back to the rental market, so the rental stock is quietly disappearing. This is what the Renters' Rights Pact looks like in real numbers, and the full picture is messier than the headlines suggest.
The Renters' Rights Act of 2025 received royal assent on 27 October 2025. Phase 1 came into force on 1 May 2026, that's just 6 weeks ago. Here's what changed overnight. Section 21, what's known as the no-fault eviction, is gone. For about 35 years, if a landlord wanted their property back, they could serve a Section 21 notice without giving any reason. No explanation needed, just a notice, a waiting period, and possession proceedings. That route is now closed. If a landlord served a valid Section 21 before 1 May 2026, they have until 31 July 2026 to start court proceedings. After that, the door shuts permanently. From 1 May onwards, every tenancy in England's private rented sector is now what's called an assured periodic tenancy, basically a rolling open-ended contract. Fixed-term assured short-hold tenancies don't exist anymore. If you're a landlord and you want your property back, you need a specific legal reason. Selling the property is one of those reasons. It's covered under something called Ground 1A, but you have to give 4 months' notice, and you cannot use that ground within the first 12 months of a tenancy. On top of that, rent increases are now capped at once per year. Landlords must use a formal Section 13 notice to raise rents. Tenants can challenge that increase at a first-tier tribunal. And the practice of asking for more than 1 month's rent in advance, something some landlords used to use to screen tenants, is now banned outright. The government's stated goal was straightforward: give renters more security, reduce the fear of arbitrary eviction, and make the rental sector more stable for the 4.7 million households in England who privately rent. But what's actually happened in the market since landlords saw this coming is a different story.
Here's the thing. Landlords didn't wait for 1 May 2026 to make their move. The exit started much earlier. According to an Investec analysis published in early May, landlords in London began selling up as far back as September 2024, when the Renters' Rights Bill was first formally proposed. The sharpest spike came in Q1 2025. In that quarter, 49.9% of London homes listed for sale had been used as rental properties at some point in the previous 3 years, up from 32.4% in the same quarter of 2024. That's not a small jump. That's nearly half the sales market in London being fed by landlords exiting the sector in a single quarter. The Lonres Agent Survey, which tracks sentiment among London letting agents across surveys in summer 2024, spring 2025, autumn 2026, and spring 2026, tells the same story from street level. By autumn 2025, agents were already reporting properties moving from the lettings market to the sales market. By spring 2026, with the May commencement date closing in, the mood had shifted, in their own words, from concern to confirmation. Out of 92 agents who responded to the open question on the Act's impact, the majority described the same pattern: landlords selling, stock tightening, tenants gaining confidence. And this wasn't just large portfolio landlords making strategic decisions. The data shows it was predominantly smaller operators, people who own 1 or 2 properties, who were most likely to sell. According to the English Private Landlords Survey 2024, 45% of all private landlords owned just one rental property. Those are the people with the least ability to absorb regulatory change, the least margin to survive mortgage costs going up, and the least appetite for a more legally complex eviction process. According to research published in May 2026, approximately 93,000 landlords exited the private rented sector during 2025, with a further 110,000 forecast to leave during 2026. That works out to roughly 700 former rental homes hitting the sales market every single day this year.
Let's get specific, because the numbers here are what make this story worth understanding. Rightmove's Q1 2026 Rental Trends Tracker put average advertised rents in London at £2,736 per month. That sounds high, and it is, but the annual growth rate was just 0.7%, the lowest since 2020. Median rents, as tracked by Investec, actually flatlined, £2,200 in both Q1 2024 and Q1 2025, edging slightly down to £2,197 in Q1 2026. So rents aren't collapsing, but they're not rising the way they were either, and that squeeze matters for landlords trying to make the numbers work. At the same time, two-year buy-to-let mortgage rates in 2026 have pushed above 5.7%. For a landlord sitting on a portfolio they bought with cheap 2019 or 2020 financing who is now remortgaging, that's a completely different investment. Add in the fact that mortgage interest relief was already restricted to a 20% tax credit under Section 24 reforms, changes that came in years ago but that smaller landlords have been absorbing gradually, and the margins on lower-yield London properties have become very tight. Savills research analyst Nicholas Gibson noted in May that London yields sit below the national average. When you're running a low-yield property with higher mortgage costs, stricter tax treatment, and now a more complex legal framework for getting possession, the decision to sell becomes a lot easier to make. There's also a figure from Rightmove's May 2026 House Price Index that puts the broader picture in context. The number of homes for sale across the UK is at its highest level since 2015 for this time of year, and almost a third of listings have had their asking price reduced. The influx of former rental stock is part of what's driving that inventory surge. On the rental supply side, the situation is structurally worse than the listing numbers suggest. London rental listings in Q1 2026 were 113,707, up 18% on Q1 2025. But analysts say that elevated number is masking churn, not genuine supply growth. Of properties sold in Q2 and Q3 of 2025, only 1 in 10 was subsequently re-let. The homes are leaving the rental sector for good. Rental stock in London reportedly remains around 23% below pre-pandemic levels. So if small landlords are leaving, who's taking their place? Investec's Future Living Report points to growing institutional interest, co-living operators, build-to-rent developers, professional landlords with larger company-structured portfolios. About 36% of investors surveyed said the Renters' Rights Act would actually lead them to increase investment in the sector. The logic being, once the small operators exit and the compliance bar is clear, well-capitalized landlords with proper management infrastructure can move in and compete on quality. Savills noted the same trend. Over the longer term, the pressure is likely to leave a greater share of the London rental market in the hands of larger, more institutional operators who can absorb regulatory change and invest with a longer-term horizon. But institutional supply doesn't appear overnight. Build-to-rent pipelines take years, co-living schemes need planning approval, and in the meantime, the people who were renting affordable 1- and 2-bedroom flats from small landlords in outer boroughs are competing for a tightening pool of homes. For first-time buyers, there's a silver lining here.
Mortgage application volumes for first-time buyers ticked up in early 2026. Many of those ex-rental properties, the kind of two-bed flats in Lewisham or Walthamstow that a small landlord is selling, are exactly what a first-time buyer with a deposit saved wants to purchase. Landlord sellers are reportedly more pragmatic on price than owner-occupiers, so there's a window of opportunity there. But it's a window that exists partly because someone else's investment no longer made sense.
The Renters' Rights Act was designed to fix something real. Millions of renters in England genuinely lacked security. Section 21 was used and misused for decades. The case for reform was legitimate. But what's happening right now in London's property market is a reminder that big policy changes don't land cleanly. The landlords who are selling aren't villains and they aren't heroes. Most of them are people who ran the numbers, looked at rising mortgage rates, tighter tax rules, a new legal framework for possession, and decided the investment no longer worked. The result is 30% of London's new sales listings coming from former rentals, 700 homes a day leaving the rental sector nationally, and a structural tightening in supply that won't be fixed quickly. If you're a renter in London, this affects you. If you're a buyer, this is shaping what's available. And if you're watching this market as an investor, the next 2 years are going to look very different from the last 10. Everyone is watching what happens next.